as system liquidity expands, the treasury bill market is maintaining a bullish tone with a focus on long-dated papers. Emmanuel Odiaka, Managing Director and CEO at ECOB Capital, joins me now for more on the fixed income and forex markets in Nigeria. Emmanuel, thank you so much for your time. Clearly, this market continues to be driven by liquidity, and it's always great to get a sense of the trends to anticipate and, of course, the impact on yields. So can you just give us your thoughts on what you make of the market right now?
Thank you for having me. Yes, you rightly said the important words there. Market has been driven by the impact of liquidity in the system. And what we have seen so far is that banks especially are beginning to realize that it's important to continue to manage the cash reserve ratio debits that occurs every other fortnight, Fridays. And in which case, there's a sense of flight for safety to put away liquid bank funds into securities assets to avoid the impact of cash reserve ratio debit. In this sense, we have seen a market that has been very bullish in cherry-picking yields on the bond side and on the treasury bill side. While market opened with the intuition that yields was going to move northwards further into the 17% level on the treasury, on the longer ends of the curve, we have seen market peak at about 16%. With the cash reserve debits reoccurring every other now and then, we've seen yields declining. Yes, going into this week, we have also seen what people tend the impact of the election. We at ECOB Capital don't believe it's an impact of the election, but yields have declined. But looking further, for a market that's awash with over 992 billion naira, there was the need for participants to continue to cherry pick high-yielding assets on the curve.
Right. Okay. So let's talk a bit about the MPC and what it's likely to do. Of course, they did hike rates at the January meeting, and of course, this month the big focus has been around the elections. But we still have that small matter of an MPC meeting later this month. How do you see the dynamics around inflation and liquidity impacting those decisions?
Yes, the MPC has hinged its policy direction now on inflation targeting. That is why we have seen MPC increase rates to ultimate high where we are right now. We are still of the opinion that the monetary policy will continue to focus on inflationary targets. Like they said in their last communique, they still do think that there are headwinds that could push inflationary pressures down going into the year. And one of it is the election. Yes, we are still in the electioneering season. We're about concluding the election with the gubernatorial elections coming on the 11th. Aside that, also, there is the concern that going into the year, we could see inflationary pressures built from the removal of fuel subsidies. And we understand the impact of transportation on the subsidy domain and inflationary pressures. So yes, inflation, it's a major concern for the Monetary Policy Committee, and I think they will continue to look closely at the numbers that comes out, possibly before they meet on the 20th and communicate on the 21st to see what direction they will go. But if we look at their body language, we think they will continue with the tightening cycle. We might not see them touch the monetary policy rates in this time. However, they are going to stand on their words to continue to make it a pivotal part of the policy.
Okay. A quick view on the exchange rate. We have seen in the I&E window that rate gradually inch up over the weeks. And is this a sign that the central bank is allowing, to some extent, an equalization of those rates, the parallel market rate and the official rate?
No, I don't think so, Wale. We are very far away from when we look at the parallel market rates and the I and E window right now. I think possibly it's just a demand push on the I and E window that has made the rates to come up there. And we also see some advancement in the parallel market, especially to the build-up to the presidential elections. And we most likely could link that to the impact of the Naira redesign and the cash withdrawal from the system. Possibly, there are some persons that feel safer holding USD assets at that moment. And possibly also we cannot rule out the fact that we saw politicians sharing USD cash to some electorates at some point. People could say that were social media issues, but we obviously saw some electorates saying that they were giving cash at that point. But that's not a part of this discussion. But it's important to note that there were some pent-up demands to the build-up to the presidential election, which impacted in the parallel markets.
All right, let's leave it there. Thank you so much for your insights today, Emmanuel Odiaka, Managing Director and CEO at ECOB Capital.